So thank you, Prem. It's been great to get to know you, and that was only recently, although he's been in our stock for a while, and so much appreciated. But I can understand why, I don't know how he feels about this phrase, but I can understand why people called him the Warren Buffett of Canada. The style, the success, and the way he views things, from what I can tell, certainly are very, very similar. With that, I'll get into my presentation. I will say that the title of my slide was How to Create Value in a Volatile Environment. And never in my career have I seen the volatility that the oil industry is experiencing. And of course, a lot of industries have gone through this. The pandemic impacted us all. But we had the greatest drop in demand ever in our industry. 15 million barrels a day demand drop in the second quarter of 2020. It was shocking. It was incredibly scary, not just from the standpoint of our company, but for our employees and for their health and the health of their families. The stresses on everybody involved were so extreme, as all of you know. So that followed, or that was actually preceded by a price war between the Saudis and Russia at the time. So that caused prices actually to drop before COVID was declared a pandemic. And that was the week that I had the toughest decision of my career, and that was to cut our dividend. We saw this demand destruction starting to happen. We saw prices dropping. We knew that something was impacting the world that was going to be a very difficult thing to deal with. But doing that at a time when I knew that there were people in tough times that were going to need to depend on that dividend, and it was no longer there for them. That was tough for me to deal with. I would say that beyond that, the invasion of Ukraine was something that was completely unexpected, and certainly something that should have never happened. So dealing with all that, and now the uncertainty that's been caused by that, and the inflation and supply chain issues that we're having to deal with as other industries are. And for the first time in my career, I started getting emails from our employees worried about what's happening in the world with respect to social issues, and especially in the United States, and wanting us to take a stand. And we decided we needed to take a stand. And I would say we never take stands on any political issues. But when we see people needlessly being attacked, like the attacks on the Asians in the United States, just random acts of violence against people they didn't even know. Same thing happening with some of the African Americans in the United States still. So we're not where we need to be as a society, but we want to be, as Occidental, we want to be an example of what the society should be. So we're working internally to try to ensure that we have the right culture and respect for everyone. So our diversity, inclusion, and belonging program has become now much more important to us than it's ever been. So we're doing things to try to help our employees deal with the volatility, but as a company, I want to take you through some of the things that our industry needs to do and that we're doing to deal with some of the greatest challenges that we have going forward. But before we get to that, I'll just give you a quick overview of what Oxy is. We have essentially now 4 businesses. Primarily, the oil and gas business delivers the most value. And right now, we produce about 1.2 million barrels a day. 80% of that is from the United States. The other areas are the Middle East, mainly Oman and Abu Dhabi, and Algeria and North Africa. Our chemicals business, we have 21 plants in the United States, 2 outside the United States. But we are the largest merchant marketer of caustic soda in the world. We're the largest exporter of VCM in the world from the United States. We're the largest marketer also of potassium hydroxide in the U.S., second largest in the world. We're the 3rd largest chlor-alkali producer in the world and the 3rd largest domestic supplier of PVC. So our chemicals business plays a big role in the chemicals business in the United States. And this past year delivered quite a bit of value to us. Our midstream business mainly exists to ensure that we get our products to market and that we get them there in a timely manner and for the best value possible. But our gas plants fall within that midstream business. So our big Al Hosn plant that we're 40% owners of in Abu Dhabi, and our Dolphin ownership in Qatar are a part of that midstream business. All of our CO2 processing plants in the Permian are a part of that midstream business. And then our newest venture is in what is growing to be a business is our low carbon ventures business. That is something I'll talk about a little bit when I'm talking about the challenges that our industry faces. But then going to the challenges slide, when we look at this, everybody could say, yeah, those are our challenges too, and we have the exact same list. And that's true, but we in the industry, in the oil and gas industry, are facing this from a different perspective. A lot of people want our industry to go away, and a lot of people think it can go away. And so I'm going to tell you in this presentation why it can't go away and why it shouldn't go away. So climate change is something that is relevant, that we have to deal with. And the sustainability associated with that is also an important thing. So that I'll go into those in a little more detail later. Geopolitical dynamics has always impacted the oil industry, but now it's even to a larger degree than it's ever been. The external pressures, and the reason I put that there is because now we're getting pressure from many different forces. As society becomes more divided, the pressure on our industry becomes more challenging and complex to deal with. For example, I very much appreciate the fact that President Biden has set some aggressive climate and emission reduction goals for the United States. It's really important, and we need to strive to achieve those. But I don't like that he only gives us 10 years to live. So that's not helpful. On the other hand, I like the fact that Senator Manchin put together the IRA bill. It's going to be very much needed for the technologies that will drive the companies of the future and the drive for us to become convert our world into a lower carbon world. Critically important, and that came from the Democrat side. But I do appreciate the other side of the aisle that helps businesses stay in business and helps regulations with respect to financials become something or stay something that we can deal with. But here, regulation with respect to our challenge, one of the things that we've never fought and will always be a part of helping to drive the solution to is regulation around methane. As I'll talk about later in this presentation, methane and CO2 are two of the things that we need to more aggressively deal with in our industry to be a part of the companies that earn the right to continue to do our business. Sustainability, a part of that is just making sure that you maintain your social license to operate. So regulation is something that we've worked with EDF and others to try to make sure methane regulation in the United States is enhanced and enforced, put in place quickly so that we can get our industry to where it needs to be. And then the workforce, when you're in an industry where some people think you should go away in 10 years and others think that you should go away today, it's challenging to attract people to our industry. But I'm proud of the fact that our company, because of the strategy that we've executed, has now differentiated ourselves from others in that when people come to work for us, they do it oftentimes now because of the fact that we do have a strategy around how to change our company, how to become what I believe every company in our industry needs to strive to do. And many companies are striving in their own way to do what we're doing. They're just doing it differently. Before I get into what our strategy is and what we believe a solution to some of the issues our industry faces are, I'm first going to talk about where our industry is. And the one thing that I think that is important for people to know when they're investing is and they always ask, what do you think oil prices will be? Almost every meeting I've had with our shareholders over the past few years, that's been the first question and the one that we have to talk a lot about because certainly it's going to be a big driver of the value creation. But here this slide shows how going back to 1986 to current, what oil prices have done. Some people are still using the mid-cycle, or believing that the mid-cycle price of oil is around $50 to $60. But if you look at this slide, this shows nominal WTI prices from 1986 to now. But when you look at real prices, which is the graph I'd wanted to use, from 1986 to July of 2004, real prices for WTI were about $36.75 per barrel. From July 2004 to now, it's been $83 a barrel. So we went from before 2004, $36.75, now $83. Part of what drove that was just the globalization and the growth in in Brazil, India, China, and in Russia. So in those countries, starting around 2003 and going into 2004, the economy of China grew by 2.5 times. The economy of India by 2 times. So at the time, the world economy grew by only 30%. So that really started the trajectory of changing the oil and gas industry with respect to not just demand, but where the new floor of prices would be. Looking at this, you can tell that, well, you'll see the financial crisis in 2008 didn't last for very long. Prices went back up, recovered pretty quickly. And then you can see that in 2014, there was a price drop. So from 2013 to 2014, what was happening there is the fact that that the shale revolution in the United States had started, and the investors were very happy with the growth, and so the growth investors were putting more and more money into the development of shale reserves in the Permian, the Bakken, the DJ Basin, and the Eagle Ford. And so that price was driven down at the time, partially by the fact that that we were oversupplying, and that oversupply was coming from the shale in the United States. So the shale revolution actually changed global dynamics in the market and caused a price drop that didn't recover until around 2018. And but now, even with the pandemic having impacted, you see the drop in price there. It went negative for the first time ever in the history of our world. But now has started to, prices started to recover. The recovery from the pandemic was certainly faster than we expected it to be. But when you look at this, at prices now, I do believe that on a go-forward basis, we're looking at prices that are certainly higher than they were pre-2004. Where they'll land now is going to be determined by how quickly China recovers, but India certainly has a good outlook and looks to be growing for the near future more than China, in my opinion. Prim would know better than that, better than I do. But during this time, 2003 to 2013, there was a super cycle in other commodities too, as there was in oil, and so these all have been driven by things that now may or may not have been changed. So we'll see how China works out over the next couple of years. But when you look at this and then look at that period from 2010 to 2014 before the drop, part of the problem for our industry is the fact that during that time we weren't delivering the returns that we can deliver today. For example, last year in 2022, we delivered a return on capital employed of 24%. And going back to, I don't show it, it doesn't show here, but when you look at the real price of what happened in 2011, that was a little bit, almost as much as it was for 1990. Well, it was a little bit more than last year, 2019 or 2022. So when you look at that compared to that prior period, our prior high in 2011, we actually delivered a higher return on capital employed. And a lot of that's being driven by the fact that the industry during that time period was frustrating investors because there was more focus on growth than value. And that focus on growth came at the expense of value at the time. And so we went from 2011 where our companies, our peer group, on the average delivered about a 13% return. That dropped to 10% in 2013 and to 7% in 2014. So we had value destruction as people were trying to take advantage of higher oil prices rather than value creation. I think our industry learned a lot then, and I think our industry is a lot more disciplined and focused on doing the right things to create value. And I think that that's showing now in the fact that there hasn't been a rush to increase the rig count in the United States as a result of prices here recently being a bit higher. And when you look at what's happened to our industry from an investment perspective, back in 2008, during that period of high prices, we were about 16% of the S&P. That dropped and has continually dropped from 2011 to 2014. Again, frustration with our industry. Here we were in a high price environment and not creating value but destroying value. And as you look over to the right, post-pandemic, it's been really difficult for our industry, but we have come back up to about 5% of the S&P, and historically, we haven't been exactly in the top of the S&P. You can barely see where the red line is. That peak was before the financial crisis, and then a steady decline afterward. So clearly, we had work to do from a value perspective. But if you look at what's happened last year, as Prem said, we had the highest return of all the companies in the S&P 500. We beat our oil and gas peers, delivering 119% return versus the next closest at about 94%. And so there were quite a few companies starting to deliver value and getting back to where our company should be. And this was not only driven by this commitment to use our dollars more wisely and to be more efficient than sloppy. There's been technology advancements that have really helped our industry, I think, get to a point where the return the return of capital and return on capital is going to be something that's more consistently delivered to our shareholders over the next few years. So I think there's been a shift, both that is sustainable because of the fact that we have the technology. We've clearly gotten the message that we have to build a business that's sustainable, that's clearly sustainable, where you can understand what the value creation is going to be. So now I'm going to talk a little bit about the climate challenge and then go into what our strategy is to address it, again, both from a climate challenge perspective and sustainability. So what we face today is there's about 50% more CO2 in the atmosphere than there was in pre-industrial times. And according to the IPCC latest model and their prior models, the only way to cap global warming at 1.5 or 2 degrees is to remove CO2 from the atmosphere while also starting to reduce the CO2 that's going into the atmosphere. We have to do both. So CO2 is an issue that must be dealt with. Keep that in mind. And then the second thing I'll say is that if you notice that the greenhouse gases going into the atmosphere, electricity is about 27% of that. So our challenge as a world is that even if we've replaced that part of it, took that 27% away by building wind and solar and could do that quickly, there would still be 73% of the greenhouse gases still going into the atmosphere. So just building wind and solar won't get it done. We need to do it, but we can't do it fast enough. So we've got to do other things as well. Also building EVs. Although I like electric vehicles, I don't have one because I drive a Jeep. But others, my friends, do, and they love them. But the problem with EVs is that we would need more electricity, and that that we have to have more reduction in the CO2 emissions and greenhouse gases from these other processes, from transportation, from heating and cooling and refrigeration, cement, steel, plastics, ethanol plants, refineries. A lot of things that that we have to do to further reduce CO2 and get it under control. The transportation part of that, we feel like we have a strategy that we can address that. So while wind and solar and another technology I'm going to tell you about can address the electricity, we believe we can produce oil that, and get others in our industry to do the same, that will address the transportation issue. So now going to the next slide, what we believe is the strategy that it differentiates us from our peers in the industry, both here and in Europe, is that we've developed a strategy that takes advantage of our core competence. We have for 50 years been doing CO2 enhanced oil recovery in the Permian Basin, and we're the largest handler of CO2 for enhanced oil recovery in the world. And what that is, you know, I failed to ask the question, are you all oil and gas investors, or is this a diverse group? Diverse. Okay, let me explain what CO2 enhanced oil recovery is then. In the oil industry, some of the reservoirs we develop have always been, up until I would say around 2005 or 2006, have all been conventional developments. And so these are reservoirs that have good porosity and permeability, but still there's little tiny micropores within all those reservoirs where oil gets trapped and can't ever get moved unless you put CO2 in the reservoir. So if you think about your, you know, like a quartz countertop, and you maybe spill your red wine on a quartz countertop that's not sealed, what happens is that red wine can migrate into pores in that quartz countertop that you can't even see. You don't see the pores, but the wine goes in there. That's kind of like what happens in a reservoir. Oil is migrated into these reservoirs that have some porosity that you can see with the naked eye, very little, but some that's even hard to see with a microscope. And that's where oil, normally that oil just stays in the reservoir, you never get it out. But if you use CO2, the CO2 molecule has the ability to get in that micropore, expand that oil molecule, lower the viscosity, and it pops out, and it then can be moved from an injector to the producer and recovered. That's an explanation that I know it takes quite a few times. If I had a film, it would be easier for you to see. But in conventional reservoirs, we don't get 100% of the oil in the reservoir. And a lot of reservoirs, you only get 35 to 40% of the oil in the reservoir. But if you apply CO2 to that reservoir, you can do what I've just said and energize that oil that is otherwise left in the reservoir, recover it, and that can get you, we've recovered as much as 75 to 80% out of conventional reservoirs doing that. And if you look at the shale play in the United States, the shale, we only recover 10% of the oil in the shale. But think about it, if you use CO2 in that shale, we've done tests that indicate we can almost double the recovery. Not quite, but we can get up to 18% recovery instead of 10% recovery. So two things are really important there. First of all, that when you recover the oil out of those micropores, CO2 has to stay and has to go into that pore because you can't have an empty pore. So the CO2 occupies that space that the oil vacates. So putting CO2 in an oil reservoir does allow you to sequester that oil. So that's one point. The second point is with CO2, you get more oil out of fields that are already developed, so you don't have to spend the money to build the infrastructure in a new area. And so that makes also the oil coming out a lower carbon oil. And so it takes more CO2 injected into a reservoir than what that incremental oil that it causes to be produced will emit when used. So when you do the math on that, it's it becomes that it turns out that you can produce net carbon zero oil or net carbon negative oil. So that to me and to us is the best way to develop oil reservoirs around the world, because the last barrel of oil produced in the world should be a net zero or net negative barrel of oil. So doing that, producing net zero or net negative oil allows that oil to then be used for jet fuel and for maritime fuel. United Airlines is a company we've been working with and hope to ultimately supply them with net zero jet fuel, because that will come from our net zero oil. So that's our strategy. It's to make sure that we're managing the methane emissions within our own operations, getting those down, but then developing a system for carbon where we can not only take carbon out of the atmosphere, we can take carbon out of or capture it from industrial sites, and we have a place to sequester it. The Permian Basin has the capacity to sequester all of the emissions from the United States for 28 years. It has that much capacity. So we do have a solution, and we not only have a solution that will help us become carbon neutral, but this gives us the way to help other companies and industries address their carbon footprint as well, and to offset their carbon footprint through the use of purchasing credits from us. We think this is so important for Oxy, for our industry, and for the world ultimately, that this will be a new business for us over time. We're taking some baby steps with it until we can get it more optimized. But then when we do, we believe that we will have a major impact in the process of helping mitigate climate change. And this shows just the process, just the emission sources, and the technologies that we can use. The direct air capture facility that will be a part of us being able to take CO2 out of the atmosphere is a technology that we came across just a few years ago. We've been trying to work a solution to this carbon issue for about 12 years, but was initially trying to do it from an anthropogenic sources, but then developed this new technology. So we're using that as our process now, because we can control our own destiny. We can do this without having to get agreements from the emitters, and that enables other businesses to be able to have a way and a strategy to lower their emissions. So that is the way we feel like we need to deal with the climate issues around the oil and gas business. And if we could get the entire industry to do that, there would be no reason to shut down oil and gas. Oil and got development really could and should continue for the next 60, 70, or 80 years, because it's really what we've become so divisive as a country in the United States that we don't talk about the real problems. We talk about the things that matter to us emotionally, but not the things that are logically the best thing to do. So in the United States, we haven't focused as much on the emissions. We've focused more on the fuel source. So you're not really, if you're doing that, you're not creating a scenario where you could actually have an effective strategy that works, because the strategy that most people, or that some people want, which would eliminate oil and gas, would be way too expensive for the world to implement. We can't get there with the path that's been established and that's being promoted by some. The world will never get there. We will leave people behind, and people will be continue to be poverty-stricken in parts of the world that we don't ever have to go see, but that exist and that needs to be able to develop their own resources. So with that said, I wanted to talk a little bit about how the other thing that this strategy will help do is, as you can see here, the blue is the production from conventional sources. And I know everybody's heard about the shale revolution in the United States before I mentioned it. The shale revolution really changed the United States because if you look at it, the production we had come from conventional reservoirs. That production had peaked at around 10 million barrels a day, but had dropped right now today to around 4 million barrels a day. So had we not had the shale revolution, today the United States would not be energy independent, and it wouldn't even be close to it. So the shale revolution changed that, and that significant growth that you see was driven in those years where we were just finding our way, developing the technology, and again, a lot of value destruction in that process, but now to a point where that industry, the shale industry in the United States, is a very efficient industry, and one that needs to continue to grow to be able to provide the U.S. and the world with the oil that's needed. And using our method, it'll be lower carbon oil. But the other thing is, from an energy security perspective, for not just the United States, but for other places, even here in Canada, where you have some EOR production from CO2 enhancement, which is right now not a large volume, but a successful volume from what I can tell. So here, to be able to almost double the recovery of oil from the shale and the conventional reservoirs means the United States won't be in an energy-starved situation here in the near future. We can continue to provide the U.S. with the oil needed to maintain independence around that. And I think for the U.S. to be energy independent is critically important for the security of the world. And so I think our strategy also helps with that. Now, going to the other things that we believe provides us the ability to have a sustainable development portfolio, one that creates value, is just the high-quality assets that we have today. We have an excessive development inventory. We have 15 to plus years of development that still is in process, and we're positioned right now with our cost structure for a $40 break-even price. But along with this, you have to have not only high-quality reservoirs in a low geopolitical risk, because with the acquisition, we were able to go from 50% of our oil production internationally to 80% production domestically. So from a geopolitical standpoint, we have right now a safe portfolio. And exceptional execution is important. And if you're looking to invest in the oil and gas industry, that the one thing that I did mention is that position for $40 break even. You want to look at the cost structure of the companies you're considering investing in, and what is their break even, and what vulnerability do they have in price variations. That's an important thing to look at. One way you can look at it if they're a shale company is how are they developing their wells. This curve shows that for the past 7 years, we have every year increased the productivity from our shale wells. And if you paid attention to the oil and gas industry, other CEOs have stated that their productivity is going down. So when your productivity has plateaued or is going down, that means you're starting to either you're not developing, your team is not developing the technical expertise to get more out of those reservoirs, or the quality of your portfolio is declining. So that's an important thing to look at. The other thing to look at is that is how well you're doing versus your peers, and this shows us that the cumulative oil by operator in over a 6-month period and a 12-month period, and we're still beating our competition, and it all gets back to a focus on technical excellence and execution. And with that, I know we got to go to Q&A, but just to say that from a cash flow priority perspective, what our first priority is to maintain our base production, then to have a sustainable and growing dividend. We also believe that as long as that we're undervalued, repurchasing shares has to be a big part of what we're doing. And currently, as we do that, we're also buying back the preferred Berkshire equity in our stock. Then beyond that, asset enhancement, meaning growing production as we go, not as much as the industry did prior, where growth was the driver, but in a way that allows us to continue to meet the other cash flow priorities. And then debt reduction and cash flow are critically important to us. Then the last one is that we're combining everything. We have synergies between our oil and gas business, our chemicals business, and our low carbons and midstream business. So everything we do, we don't do anything unless it's a part of our core competence, unless we have the competency already to do it. Some companies have gone to wind and solar and have invested in and started making that we're not going to be what we aren't. We're not going to try to be what we can't do today. So with that, I'll pause for Q&A.
Thank you very much. Thanks a lot, Ms. Hollub, for doing this. I'm an Ivey MBA graduate and hold 5 years of infrastructure private equity experience in India. Currently, I'm interning at BCI in their infrastructure department. Your net zero system concept really caught my eye, and I just wanted to ask you that there's this one cycle wherein institutional investment is trying to drive the ESG change, but at the same time they shy away from investing in players like ONG. So how do you see this problem? Like, how do you see you can mitigate this and you can attract more institutional investments?
I think first of all, you guys see my challenge with trying to help people understand what our strategy is and why it's so important. We've got to get people to realize that they need our industry. So moving away from oil and gas is going to make the world a more volatile place and a more dangerous place. So short of being able to convince people of that, what we're trying to do is to be more transparent about how we're managing our operations, what our emissions are, what we're doing to mitigate those. And I think transparency and building trust, working with organizations like the Environmental Defense Fund, having them come in, understand more about us, so that we can work with them to try to help our industry develop the regulations and rebuild the trust with not only the investment community, but the ESG community, the governance people. We spend a lot of time with them, and I think it's not going to be easy to build that trust. It's not going to be easy to get them to understand that we like they want to be better at what we do, and we want to protect the world, but we also know that without us being better and getting to the point where people trust us and understand that our goals are the same as theirs, until we can get there, we're going to be in a difficult place. And so we're trying as fast as we can to increase that transparency and to work to help people understand what this strategy is.
Just to kind of steal Prem's question from the introduction, what do you think it is that Warren Buffett saw in you as a CEO? There's a lot of oil and gas companies out there, and he's highlighted you by name as a big reason he's invested in Oxy. So I know you're humble, but if you wouldn't mind sort of explaining in your opinion what he saw in you, and then just as an adjacent question, if he's given you any advice that you'd be willing to share.
I would say that I hope that what he saw in me is that Occidental is not just about me. Occidental is about a very strong leadership team. And unlike my predecessor CEOs and some CEOs in our industry, we work as a leadership team. I'm not someone who thinks that I have all the answers, and I'm not someone that's command and control. I'm not someone who thinks ever that I'm the smartest person in the room. But what I am smart enough to know is that we need a leadership team and a very diverse leadership team to be successful. And I would say that when I had to go to Mr. Buffett to ask for $10 billion to make that acquisition work, I told him at the time that we were going to create value from that acquisition, that it would work, that we would achieve the goals that we would set out. We would achieve our divestiture goals. We would achieve our synergies, which were higher than our competition. We had $2 billion of synergies that we expected to achieve, and we would then reduce our debt and get our cost structure back down. And so now our cost structure today is at $40 break even. We achieved synergies and divestitures well ahead of schedule despite the pandemic. We never veered from what we were doing in terms of strategy, because we knew we were on the right path, so we didn't get distracted and panic. And also the big thing is those charts at the end. He sees those charts. Those are third party prepared, where people look at how is our execution in the Permian versus others. And our team is doing a better job than others. And the reason they are is we put a strong emphasis on making sure that you have the best talent in the industry that can deliver a better understanding of the subsurface, because if you don't understand that, then you've lost a lot of value before you even get started. So in the oil and gas industry, it's all around technical excellence, subsurface, and then getting the highest quality assets, and then being able to execute on them. And I think certainly Mr. Buffett saw that, and because he gets third-party information and he can look at it. And he told me when he started investing in a big way here this last year that he remembered me saying that I was going to create value for him. And he said, I trusted you. And he said, and you've done it. But it's been through the leadership team. We have a great process to do that. And with respect to advice, he doesn't directly tell me what I should do, but what he does do when I visit him is he talks about investment. He talks about the things that companies should do to create value, and I think he's in his own way ensuring that I don't lose sight on what adds value, and that I don't stray too far from knowing that the path we're going down has to be well thought out. We can't go down this path of creating a new carbon management business to help ourselves, our industry, and the world, but without ensuring that we're still creating value for the shareholder. And he's very, as you know, shareholder focused.
Vicki, thank you very much for your presentation, and congratulations on what you're doing and have achieved in Oxy to date. Very encouraging.
Thank you.
Two questions. Could you talk a little bit about your expectation for CapEx over the coming 10 years, and whether that, how much that may ramp up given the DAC program that looks very, very promising? And second, is there a price of your shares that you would cease the buybacks and increase the repurchase of the preferreds from Berkshire?
I would say that our CapEx is going to be driven by the pace of growth of the need for cash. And so we have multiple ways to create value. 60% of our production, oil and gas production today, is shale, 40% conventional. So we can develop in either one of those. We have a chemicals business too that we want to grow over time, and we're doing a project now that'll increase our Battleground facility by 80%, the production by 80%. So we're doing projects in all of our businesses. So trying to estimate a CapEx increase is difficult. And the CapEx increase is really a result of what are the opportunities that we see now, because we'll be combining chemical opportunities with oil and gas, and hopefully in a perfect world for us, those developments would occur concurrently over time. And then I would say that on the preferred, we had a $4 trigger, meaning that delivery of $4 per share to our shareholders triggers us having to buy the preferred. And so we said in our last quarterly earnings call that we were going to repurchase $3 billion of shares. And so we said it's likely that we would trigger needing to buy the preferred in Q1. And so we'll have our earnings call May 10th, and I'll be able to share where that is right now.
Thank you very much for your presentation. Could you talk a little bit about the outlook for your petrochemicals business? And particularly being North America centered, the advantage that you have versus other crackers, particularly in Asia, that ultimately are using naphtha as a feedstock versus the opportunities you have with natural gas?
Yeah, I would say that we believe that the opportunity for our chemicals business to grow is certainly there. because we do have, in the United States, what you're alluding to is we have a very low price of gas right now. And with all the LNG being developed around the world, we see natural gas prices probably staying at $3 or below here in the United States for a long period of time. So we do have a competitive advantage to a lot of areas internationally to grow our chemicals business and our chlor-alkali business. So I would say that it's certainly there are healthy opportunities. We're going to be very careful, though, about where we do invest. We certainly like India, and we like some of the Middle East areas, especially Oman and Abu Dhabi, where we are today. So those would be our focus areas of trying to do business with either providing either ethane or actually building plants in those areas would be something that we have considered and would consider.